Welcome to Investment Gains, a channel dedicated to help new investors gain knowledge and experience in the investment world. My name is Tim, and I want to first congratulate you on making the first step to financial freedom by investing. In this video, I'll go over briefly 4 investment strategies and I will give you some tips that will help you make a better decision before investing. If you are new to this channel, consider subscribing. I'll also appreciate the early thumbs up because it really helps out the channel, and more importantly, it's free. Let's get those gains. What is investing? Investing, according to Investopedia, is the act of allocating resources, usually money, with the expectation of generating income or profit. Please do not mistake investing with trading, as the two are very different. There are so many investments that you can get involved with, but the best investment you can ever make is investing in yourself. To invest in yourself, you first need to ask yourself 2 questions, and depending on those answers will help you determine the type of investor you are. Question number 1. What do you want to achieve? Create a goal for yourself. Maybe something simple like achieving $1,000 in investment over the next 5 months. And if you don't have the answer right now, that's fine. Next, set out your goals. Everyone has different needs, so you should determine what your needs are. Whether it be saving for school or trying to retire early. Working without a goal is like walking around with the lights off. Question number 2. How can you achieve this goal? Maybe you can withdraw $1,000 from your savings account to achieve your goal of meeting $1,000 of investment within 5 months. Or maybe you have to invest $200 a month for 5 months. In order to achieve your goal, you will have to figure out what your risk tolerance is. Your risk tolerance will be the amount of loss you're able to withstand as your investments fluctuate. Now, determining your risk tolerance is not complicated and is normally determined by several key factors, including your age, income, and how long you have until you achieve your goal. Technically, the younger you are, the more risk you can take on. The answers to these questions should help you determine the type of investors you want to be and will also help you build a portfolio based on your strategy. Now, let's jump right into the tips that will guide you on your way as an investor. Tip number 1. Choose your investment strategy. Now that you have your goals in mind and you know how to achieve that goal, it's time to choose your strategy. I'll go over 4 strategies that you can use to begin investing. Strategy number 1. Dividend investing. Dividend investing is a strategy of buying stocks that pay dividends in order to receive a regular income from your investments. This dividend income is in addition to any growth your portfolio gains as it increases in value. Dividend investing is one of my favorite strategies because it generates passive income over time. Strategy number 2. Value investing. Value investing is buying stocks or funds that are undervalued with the expectation of making gains when the market catches up to the stock's real value. I think it may be simpler if I try to explain. So, let's say a company has a value of $10 per share last week, but has a share price of $5 this week. When you buy the stock this week, you can get twice as much as you would have last week. Hopefully, that makes sense. The ultimate value investor out there is Warren Buffett, and there will be videos to come about this great investor and his strategies. Strategy number 3. Growth investing. Growth investing is the process of buying companies that offer strong upside potential for the future of their earnings. This strategy evaluates the company's current stock health and its potential to grow over time. This is not to be mistaken for speculative investing. And strategy number 4. Dollar cost averaging. Dollar cost averaging is the practice of making regular investments in the market over time. This strategy works hand in hand with the other 3 mentioned before. With dollar cost averaging, you may choose to put $200 in an investment account every month, like I do, which makes it my favorite strategy. This approach takes discipline and can be automated to make the process a lot easier. Most online brokers offer this feature for free. Dollar cost averaging is a sure, consistent way to grow your portfolio over time. Now that you are sure of your strategy, it's time for tip number 2. Tip number 2, check your emotions. Always keep your emotions under control and don't make decisions based on price changes in the short term. The market goes up and down, and that's just what it does. When buying and selling based on emotions, you are given in to what the market wants, and that's when you lose money. To avoid this, you will need a plan before getting into an investment. That way, you will not allow short-term fluctuations in share price to affect your long-term goals. A sure way to help keeping your emotions in check is to not check your portfolio daily. This is advice from my own personal experience. Tip number 3. The third tip I can give you as a new investor is to avoid penny stocks at all costs. Penny stocks are stocks under $5. Their price makes it very attractive to new investors, but don't get caught in this trap as they are very volatile. The market has lots of good value stocks and ETFs that you can invest into that's not risky as penny stocks, and they are also affordable. With new technology, all stocks and funds are very affordable because most brokers now allow you to buy fractions of shares in these companies, so you don't have to spend a lot of money all at once. One of these brokers is Robinhood. This is an online free broker. Robinhood is a free online platform that's easy to use even for beginners. There's lots of free apps that you can use, but I use Robinhood because of the ease it is to buy and sell, and also the instant deposits are available to be used right away. I'll leave the link in the description below so you can get started. Tip number 4, time in the market. My last tip of the day will be time in the market. Time in the market is not to be confused with time in the market. Time in the market refers to the length of time that you have been investing your money and it's allowed to grow. As a new investor, you will not benefit much from dividends or growth because your account is in an infant stage, but continue to invest and you will see the rewards in as little as 6 months to a year. Whether we are in a bull or bear market, your investment will grow over time. Patience is key. Now, to conclude, as a new investor, there is so much uncertainty, but as an established investor, I can tell you that the investment strategies and tips that I mentioned will not make you rich, but will put you on track to creating a portfolio you can be proud of. If you want to become rich, and I'm sure you do, then you need to have 3 things. Have discipline, consistency, and patience. Being wealthy is not an overnight thing, and if you try to rush it, then you will not be successful. Decide on a strategy, be consistent with it, and have patience, and watch your investment gains over time. Thanks for watching, and remember to like and subscribe so we can help each other with our investment gains.